We're here today to launch our March bi-monthly report, our first report for 2018. All sectors of the Irish commercial property market have had a busy first 2 months. In addition to a carryover of transactions from 2017, some of which completed during January and February, there's been considerable work underway in each sector of the market, preparing assets for sale. We're now entering the traditional spring selling season and are expecting considerable activity, both from an occupier and investor viewpoint. Prime rents and yields in all sectors remain relatively stable in the opening months of the year, but we do expect to see some yield sharpening in the build-to-rent sector in due course, considering the weight of capital that's specifically targeting this sector. A busy couple of months is now in prospect in the Irish real estate sector, with a number of sizable properties and indeed land parcels expected to be offered for sale. In the office market, following a bumper year in 2017 in which more than 331,000 square metres of transactions were recorded, the first 2 months of 2018 have been equally strong, with continued momentum in the Dublin office market. Several transactions that carried over into 2018 have been signed in recent weeks, while others are now nearing completion and will provide a welcome boost to Q1 take-up volumes in due course. Demand remains robust, with a number of new office requirements having been activated since Christmas, copper fastening already strong requirement volumes in this sector. In line with the year just gone, 2018 is likely to be largely characterised by the expansion of existing occupiers as opposed to take-up by large-scale new entrants. We also expect to see some further Brexit-related announcements solidifying over the course of the coming months. The increase in large requirements activated over recent months, many of which don't need to move into new premises for a number of years yet, as well as the completion of a number of significant pre-lettings in recent months, has in turn provided the impetus for the next wave of development activity to commence in the capital. Despite some comments about the potential for oversupply in this sector, according to our research, the extent of new supply coming on stream over the next 3 years appears very well controlled at this point, with funding for speculative development remaining elusive despite the current underlying demand dynamics. Demonstrating that office leasing activity is not wholly focused on the Dublin market, Jaguar recently announced plans to lease over 5,000 square metres in Shannon in County Clare, while there are a number of active requirements for office premises in Cork, Limerick and Galway. With the pace of office rental inflation now easing somewhat, prime rents in the Dublin market have remained relatively stable in the first 2 months of the year, other than in the north suburbs of the city, where prime rents have now increased to approximately €210 per square metre. A trend that's becoming increasingly evident is the growing emergence of co-working, with flexible operators having accounted for almost 5% of leasing activity in Dublin in 2017 and likely to account for an even larger proportion of take-up in the city this year. The first 2 months of 2018 have been encouraging, and we're confident that another strong year of leasing activity is in prospect. Although it does remain to be seen if last year's record take-up volumes will be replicated. In the industrial and logistics market, having achieved take-up of almost 250,000 square metres last year, 2018 has started well, with robust demand for premises and industrial land, although a scarcity of modern supply along key road corridors does continue to frustrate. With only a handful of speculative developments currently under construction, we continue to see very strong demand for build-to-suit opportunities, particularly for opportunities greater than 6,000 square metres. Based on activity levels since Christmas, we expect to see more supply coming available over the coming months, with a number of properties and indeed industrial land banks expected to be formally brought to the market in due course, and this will alleviate pressures in this sector to some degree. Occupiers and investors continue to watch Brexit negotiations closely, on the basis that the ultimate outcome of these negotiations is likely to result in significant change to the inland distribution and logistics in the Irish market, which to some extent is changing anyway because the way e-commerce is changing supply chains. Interestingly, Dublin Port recently announced plans to apply for planning permission to construct infrastructure to deal with additional custom checks in the event of the UK leaving the customs union and the single market. In other industrial-related news since Christmas, the US hedge fund York Capital recently announced plans to float an Irish industrial and logistics REIT, focusing specifically on secondary industrial and logistics properties. The core REIT intend to raise 225 million in the London and Dublin stock exchanges later this month. With Christmas and the January sales season now firmly behind them, retailers have changed their focus over recent weeks. And there's been a notable pickup in demand in the property sector as retailers conclude various transactions and enact new requirements. Food and beverage retailers have been particularly active. A number of transactions are currently in negotiation on Grafton Street, and they're likely to complete over the coming months. This will see this street revert to full occupancy and will set a new tone for Zone A rents in the capital. Outside of Dublin, a number of retailers have completed transactions recently, and the French retailer Decathlon have recently announced plans to open as many as 9 stores in Ireland and are expected to announce the location of their first Irish flagship imminently. With recent data showing the extent to which Irish consumers are now shopping online, and with more than 60% of this online spend going overseas, the need for the Irish government to focus on online leakage is becoming increasingly important. Following a year in which more than 2.5 billion traded in the Irish investment market and total returns, according to the MSCI, reached 6.4%, the opening months of 2018 have seen several transactions being carried over into the new year, some of which have now signed or are close to completing. The supportive economic backdrop and the strength of underlying activity continue to attract investors from a range of different jurisdictions, with Ireland's comparatively attractive yield profile also encouraging investors to consider opportunities in the Irish market. Although sourcing core product and deploying capital remains challenging, a number of assets have been formally released for sale since Christmas, both on and off market, while others are now being prepared for sale later in the year, and this should alleviate supply pressures somewhat. Prime yields in all sectors remain stable at this juncture, although we do expect to see some further tightening in the multifamily build-to-rent sector as new evidence materialises over the coming months. Logistics yields remain at a premium over other real estate sectors, although supply of investment product in this particular sector remains constrained, particularly for larger lot sizes. While there's a considerable weight of capital chasing investment product both in Dublin and indeed other provincial cities, opportunities to deploy capital in the near term will be limited, as owners of good real estate assets are benefiting from good income generation potential in the current climate and are less inclined to sell. A very clear dynamic is the focus on alternatives, and we do expect to see continued demand for alternative investment opportunities over the coming months, with any build-to-rent opportunities that are brought to the market likely to be particularly keenly bid. Although there's been lots of activity in the development land sector in the first 2 months of 2018, much of the focus has been on bringing transactions that didn't complete before year-end 2017 to a successful conclusion and preparing assets for sale later this year. We expect several sizable land parcels and development opportunities to be brought to the market over the coming months, and there's no doubt but that these will be keenly bid, considering the dearth of supply over recent years. The market is waiting patiently at this point for clarity from the Minister for Housing on new standards on design and density, after which we would expect to see a meaningful increase in planning activity and in much needed development. However, as several commentators have pointed out recently, regardless of how much land is brought to the market or indeed how many planning permissions are in place, unless land has adequate services and infrastructure to facilitate development, delivery just can't materialise. The government's recent launch of the National Planning Framework 2040 and the National Development Plan to 2027, setting out priorities for regional development, has particular resonance for this sector of the market. It is now imperative that the ambitious, albeit necessary initiatives announced in these plans are delivered in a timely and efficient manner. There has been a notable increase in demand for build-to-rent and co-living opportunities over recent months, both in terms of investors seeking to purchase built stock and entities seeking to develop and manage new purpose-built facilities. Our research suggests that there's as much as €5 billion specifically targeting build-to-rent opportunities in the Irish market at the moment, with the vast majority of this capital chasing opportunities in Dublin. Having said that, the Elysian opportunity in Cork City, which is now reportedly under offer to Kennedy Wilson, was very keenly bid, demonstrating investor appetite for core product in key population centres other than Dublin also. In a very significant announcement, Hines and the Dutch investor APG recently announced a joint venture to develop more than 1,000 built-to-rent units in Cherrywood in South Dublin. As in many other sectors of the market, the first 2 months of 2018 have proven busy in the hotel and licence sector, with several transactions having carried over from last year. In addition, significant work has been underway preparing assets that will be formally released for sale over the coming months. Following a year in which transactional activity in the hotel sector was constrained by a shortage of product, particularly in the Dublin market, we expect to see significant improvement in this situation in 2018, with a number of high-profile hotel properties to be offered for sale both on and off market from the end of the first quarter onwards. Some of these sales will have been fast-tracked by capital gains tax waiver scheme changes announced in last autumn's budget, whereby assets purchased after 2011 that originally had to be held for a period of 7 years in order to trigger a capital gains tax waiver can now be sold after a 4-year period. Sentiment towards Dublin remains particularly positive and is buoyed by robust performance indicators, with average daily rates up 4% in January and RevPAR up 5.4% in the month, according to the latest data from STR. Development activity is starting to increase in this sector, with several new projects having formally commenced on site since the beginning of the year, including Tetrarch Sackville House in Dublin 1 and the Dublin Loft Company's development on Hendrick Street in Dublin 7. Dublin's newest hotel, the Ivy Garden Hotel at Harcourt Street in the city centre, opened in recent weeks. Other hotels that are due to open in the capital during 2018 include the Aloft Hotel in Blackpits in Dublin 8, the Devlin in Ranelagh, Dublin 6, and the Maldron on Kevin Street, Dublin 8, which between them will add 1,300 additional hotel bedrooms to the city. In total, approximately 1,500 bedrooms are due for delivery in Dublin in 2018. Meanwhile, there's good appetite for hotel development opportunities in other cities also, which will provide some new stock in these cities in due course. March will be a great opportunity to market Ireland from a tourism perspective, with 300 landmarks in 45 different countries all over the world due to light up green to mark St. Patrick's Day later this month. Following the completion of a number of notable investment sales in the Cork market towards the end of 2017, the first 2 months of this year have also seen continued appetite, with strong demand prevailing for good investment opportunities in the region. The Elysian multifamily investment, which has now reportedly gone under offer to Kennedy Wilson, was very keenly bid, demonstrating the depth of appetite for core, well-located product, and it's a very significant transaction for Cork. Reacting to the current strength of demand from both domestic and overseas bidders for good investment opportunities in Cork City and region, we expect to see an increase in the volume of investment assets being released for sale over the next couple of months. Although there have been very few office leasing transactions signed since the beginning of the year, negotiations are continuing on several active requirements, which will ultimately translate into take-up announcements in the second quarter. Despite the volume of office stock at various stages of the planning process in Cork, only 14% of the total potential pipeline in the city is currently under construction. In fact, in total, just less than 35,000 square metres of new stock is currently under construction in Cork, of which about a quarter has already been pre-let or accounted for. While the pipeline of new office schemes gives potential occupiers some comfort, the lack of standing stock at present is posing a huge challenge, particularly for companies whose space requirements are more immediate. The government's recently released Project Ireland 2040 has particularly positive ramifications for Cork, envisaging a 60% increase in Cork's population over the next 2 decades and significant improvements to infrastructure in the city. The assertion from the Minister that a quarter of Cork's footprint has yet to be built suggests that the Docklands region of the city will have a vital role to play in facilitating future growth in this city. In summary, the first 2 months of 2018 have been very, very busy in the Irish commercial property market, and as the official spring selling season now kicks off in earnest, we expect activity to intensify even further. To download our full bi-monthly report, please visit the newsroom of our CBRE Ireland website at news.cbre.ie.